Hey everyone, welcome back to episode 968 of Money Girl. I really appreciate you being here, spending some time with me. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. Free subscribers automatically receive my Money Success Toolkit, which includes the exact templates I use to manage my finances. You can learn more, ask questions, and sign up for the Money Stack for free at lauradadams.com. Or you can leave a voice message with your question or comment by calling 302-364-0308. I'd love to feature your question on Finance Friday. That's our weekly Q&A bonus edition of the show. I want you to imagine that you and a friend are both shopping for the exact same car, and you both get approved for an auto loan for the same amount. But your friend's monthly payment is $50 less than yours. What gives? Well, the difference comes down to your credit scores. This podcast will review why great credit is essential for healthy finances and how to build your scores. We'll cover 7 tips to build credit whether you're starting from scratch, recovering from a credit hardship, or just want a credit boost. You probably know what credit scores are, but I'll do just a brief summary here. They're typically 3-digit numbers, ranging from something like 300 up to 850. And the higher your score, the more creditworthy you appear to lenders and various merchants. It's like a financial report card that's a snapshot of your current risk. For instance, having low credit scores typically makes a lender believe you're a high risk to them because you're more likely not to pay them on time. But high credit scores tell the world that you're financially responsible, are a low risk, and will likely pay what you owe on time. There are many different credit scoring models. Therefore, you have multiple credit scores. So that's why I always talk about credit scores instead of just a credit score. However, there are 2 scores that are commonly used in the United States by, many financial institutions. They are FICO, F-I-C-O, and Vantage Score. They have the same scoring range. It goes from 300 up to 850, but they weigh certain factors differently. So here's how you can translate your FICO score. With a score range of 800 to 850, that is excellent. If your score ranges from 740 to 799, that's very good. 670 to 739 is good. 580 to 669, fair. And 300 to 579 is poor. Now, as of mid-2025, the average FICO score in the United States is 715, which falls in the good category. Now, here's a breakdown of the Vantage score. It's slightly different. If your score is 781 to 850, that's excellent. 661 to 780, good. 601 to 660, fair, and 300 to 600 is poor. And as of mid-2025, the average Vantage score is 701, which is also good. The average of both scoring models is down slightly this year, indicating that Americans are feeling more financial pressure in our complex economic environment. It's really important to understand how credit scores are calculated so you know what levers that you need to change in order to improve your scores. Your scores are calculated based on the information in your credit reports and nothing else. And those reports are maintained by 3 major credit bureaus. They are Equifax, Experian, and TransUnion. Those credit bureaus have a detailed history of information that gets reported to them by lenders and merchants. Some of the most important factors that influence credit scores are your payment history. This typically makes up the highest percentage of your scores. So even one late payment can cause your scores to decline. Credit utilization. This is the amount of debt you have relative to your available credit limits. And a good guideline is to keep your debt less than 20 to 25% of your available credit. I'll talk a little bit more about this. Scores are also calculated on your credit history length. So keeping your credit accounts open for longer is better for your scores, even if you don't use those accounts much. Your credit mix is also important. You want to have different types of credit accounts, such as installment loans and credit cards, but it is a small factor in your scores. And another small factor is applying for new credit. So applying for a new account does cause a temporary small dip in your scores. Having great credit is so important because various organizations like lenders, property managers, insurers, and the government use credit scores to make decisions about offering you loans, credit cards, apartments, insurance, and certain government benefits. Higher scores result in lower interest rates and more favorable terms, ultimately saving you a significant amount over time. Here's an example of how having fair credit could affect a mortgage payment. Let's say you buy a home for $350,000 and need to borrow $300,000. If you have excellent credit, your interest rate on a 30-year fixed-rate mortgage could be in the neighborhood of 6%. However, if you have fair credit, your interest rate for the same mortgage could be 7.5% or higher. Paying 1.5% or more on a mortgage means you could pay $107,000 or more in interest over the life of the loan. I don't know anyone who wouldn't want to save $107,000. In addition to paying less interest on mortgages, auto loans, student loans, and personal loans, better credit gives you access to less expensive credit cards that come with more rewards. For instance, depending on the card issuer, with excellent credit, your interest rate could be 15% instead of 29% with lower scores. Certain government-backed financial products also check your credit. They include FHA and VA loans, as well as Direct Plus loans. These are available to graduate or professional students and parents of dependent undergraduate students. I mentioned that certain insurance premiums are affected by your credit scores. In most states, carriers that sell auto, home, and renter's insurance use a credit-based insurance score as one factor in your rate. It's not the only factor, but it is, a significant factor in your rate. Data indicate that policyholders with higher scores tend to file fewer insurance claims. Many utility and wireless phone companies also check your credit scores when determining whether you must pay a security deposit or not. And landlords check your credit to ensure you're financially responsible and likely to pay rent on time. Even if you never plan on taking out a loan or using a credit card, you can see that your credit scores still affect your finances. Everyone who drives must have auto insurance, and few people can go without utilities, internet, or a wireless phone. So don't be shy about reviewing or downloading your credit reports for free, which never hurts your credit scores. Regularly checking your reports and credit scores is the best way to catch errors or fraudulent activity that could be dragging down your credit scores. So now that you understand the power of having excellent credit, let's review 7 tips for building and maintaining it. Number 1, you need credit accounts. It's a common misconception that being debt-free gives you excellent credit. If your credit reports have too little or no data, they can actually be too thin to generate scores. Unfortunately, having no credit score is the same as having poor credit. The bottom line is that you must have credit accounts in your name and use them responsibly to build excellent credit. So apply for credit accounts you genuinely need and can manage wisely. Tip number 2, always make timely payments. Since your payment history is typically the most significant factor in credit scoring calculations, paying your bills on time is critical. Even if you can only send your credit card's monthly minimum, paying on time builds a history of positive data in your credit reports. Likewise, making even one late payment can significantly hurt your scores. Tip number 3, don't close credit accounts. If you pay off a revolving credit account, like a credit card or a line of credit, keeping it open is better for your credit than closing it. That's because closing an account shrinks your available credit, causing your credit utilization to skyrocket. Let me explain. Your credit utilization is a ratio calculated by dividing your outstanding debt balance by your available credit. For example, suppose you have two credit cards that each have a $4,000 credit limit. And let's say you owe $0 on the first card and $2,000 on the second. Your total credit utilization would be 25%. So you take all your debt, the $2,000 divided by your credit limit, which is $8,000. Remember, you've got $4,000 on two cards. So $2,000 divided by $8,000 is 0.25 or 25%. That's a pretty good utilization. But let's say you close the first card that's got a $0 balance. You've just paid it off and you think, all right, I'm going to close it and get rid of it. Well, what happens is you instantly lose half of your available credit. That causes your credit utilization to double to 50%. So now the math is showing debt of $2,000 divided by $4,000. You've only got the one credit card, so $2,000 divided by $4,000 is 0.5 or 50%. So all of a sudden you went from a 25% utilization to a 50% utilization, and such a significant increase in your ratio will cause your scores to drop quickly. So having more available credit relative to your debt is better because it boosts your credit scores, which indicates responsible credit use. Cutting your available credit makes your scores drop so you appear less creditworthy, even if you're not. Tip number 4, don't carry unnecessary credit card debt. It's a common myth that you must take on unnecessary debt to improve your credit scores. That's dead wrong. When you need credit accounts, the upside is that you can build credit by managing it responsibly. An excellent credit building strategy is making credit card charges that you pay off in full each month. That allows you to avoid interest charges, get card benefits, maintain a low credit utilization ratio, and add positive payment data to your credit reports that boost your scores. Again, you don't have to carry a balance from month to month. Tip number 5, consider using a secured credit card. I know credit can often feel like a catch-22, especially, when you're young, just starting out, because it seems like you can't get approved for credit cards and loans without having good credit scores, but you can't build good credit scores without having credit accounts. So the savvy way to build credit from scratch is by applying for a secured credit card. Secured cards work in the same way as standard regular credit cards, but they require an upfront refundable deposit that serves as your credit limit. After you make on-time payments for a period, you typically qualify for a regular unsecured credit card. Just be sure a secured card reports your payment information to the nationwide credit bureaus. Otherwise, your payment history won't get recorded in your credit files and you won't have the opportunity to build your credit scores. Tip 6. Have a mix of credit accounts. Your credit mix, or the types of accounts you have, contributes to your credit scores. While it's not as significant as your payment history, it is part of the calculation in most credit scoring models. For instance, having revolving accounts like credit cards and installment loans like auto, student, and home loans demonstrates your ability to manage various types of credit effectively. As I previously mentioned, having multiple credit cards increases your total available credit, reducing your utilization ratio and boosting your scores. In addition, every account you own adds to your credit history, another scoring factor. However, I don't recommend opening new credit accounts you don't need or would have difficulty managing responsibly just to improve your credit mix. And 7. You need patience. Improving your credit scores never happens quickly, nor is there a magic fix for poor credit. If you're starting from scratch or rebuilding after a financial hardship, it will likely take at least 6 months for your credit scores to increase. Building credit can take even longer if you've had accounts in collections or even a bankruptcy. However, scores typically give more weight to your recent account activity. How often your credit scores update depends on when creditors report information to the credit bureaus. Generally, your account data gets updated monthly, which means your scores can change monthly. The best way to improve your credit is to pay bills on time, keep your debt balances as low as possible, and periodically review your credit reports for errors. If you find any incorrect information, like late payments or accounts that aren't yours, dispute them with the credit bureaus immediately. And going back to my opening example about getting the same auto loan as a friend, if you want a lower monthly car payment, your credit scores are the key. By following these tips, you can save money not just on a car, but on many other expenses and reach your financial goals faster. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. Steve Rickyberg audio engineers the podcast. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.